And in the case that nothing works out, right? Whatever, end of days type of scenario, where we're still kind of all in the metaverse here, talking to one another, and the world hasn't blown up, but institutions really don't carry that much cash, and I mean. That's Adam. That's probably the answer there. It's to carry enough cash to get you through whatever event that you need to get through. Now, are you going to carry more than 1 year's worth of cash based on your outflows that you have? Probably not. But what is that cash number? Is it 3 months worth of your liability? Is it 6 months? Is it 1 year? Does it change based on where you think we might be in some sort of cycle?
Market valuation?
Yeah. I don't know, but I think the answer is it's not zero, or it's not like 50 basis points. Perhaps cash allocations, if you're gaining so much efficiency from risk parity and from thinking about the alpha component, or maybe what you guys would call the stacking component of RMS and first responders, second responders, diversifiers. If you're getting that much more bang for your buck, then why not carry a little bit more cash on your balance sheet for that scenario where nothing's working?
Yeah, I'm not averse to that. I mean, I guess, again, just all of these, in theory, these all have costs, right? There's a cost to carrying more cash, right? It's an opportunity cost. There's a cost, in theory, to being long vol, right? Like in the end, if you hedge out all the risks, you effectively should be earning the risk-free rate. Right, so it's a bit of a tricky kind of situation. I don't know. I actually be curious how you sort of think about this, but the more I've thought about kind of standard trend following, just moving into trend following for a minute, the shorter the trends that you're looking to capture, the more the strategy should resemble the profile or character of a diversified long straddle portfolio, right? Mm-hmm. You're capturing almost none of the drift of the underlying assets, and you're effectively just buying long straddles and hoping that those long straddles are mispriced because there's more outliers in the distribution than are priced by the straddles. Is kind of what you're buying when you buy sort of more shorter term trend strategies, right? And when you're buying longer term trend strategies, you're buying maybe more strangles, mm-hmm. And exactly. You get you're also benefiting to some extent from the drift in markets that have mm-hmm. a long-term drift, right? So mm-hmm. if you look at kind of the long-term beta of a long-term trend strategy, typically it'll have kind of a 0.2, 0.3 beta to equities, a 0.3, 0.4 equity to beta to duration. And because it's, you're on average, because these markets do have drift, they're going to be in an upward trend more often than they're in a downward trend, and you're going to get that sort of long-term average.
It has a high correlation to risk parity.
Yeah, the longer the trend strategy,
the more it looks like a risk parity portfolio.
Yeah.
Exactly. Yeah, I mean, and in that trend following, we tend to once we blend together the strategies that we have, we end up being a medium, call it 6 month type of look back there, because within first responders we have those. When we're diversified there again across time, right? But those are more meant to kick in during the Q1s or 2020s, during those short, steep drawdowns, or the gap risk. That's the easier way to say it, during the gap risk. And then the trend is meant for, hey, is this going to persist?